business valuation. And under business valuation, we have three methods. We have the asset based, we have income based, and we have the cash flow based. Now, under the asset based, we've done everything on the asset based. Under the asset based, we have historical method, net realizable value, replacement value. Under income based, we've done P ratio, earnings yield, EV, enterprise value, EBITDA, you can remember. Now today we are entering cash flow based. And today, under cash flow, we are going to be treating dividend yield. I hope we are able to finish it today. So let's just start. Now, the last time we treated earnings yield. Another earnings yield, we said earnings yield equals earnings over what? Market value. Now, market value and market price. So now, today is earnings yield, so we can say that using the same formula, we can just use it for what? Dividend yield. So we can say dividend yield equals to dividend over what? Market value. Now, dividend, after you do your financial statement, then you get to your operating profit, then you less income, you less finance cost, and you less tax. You stop at profit after tax. Now that profit after tax, some percentage will go to dividend, and some percentage will go to what? Retained earnings. So they may not give you directly and say that, okay, this is our dividend. But they might tell you that the profit after tax is so, and your retained earning is something percent. Then from that, you can get your what? Your dividend. So just know that after you get your profit after tax, some percentage will go to what? Retained earnings, and some will go to what? To dividend. So as we are treating questions, we're giving out some formulas that we are going to read. So let's just start with question 1. So now we are going to be dealing with dividend with growth and dividend without growth. So we are going to start with dividend without growth. So now, so the formula for dividend without growth is what? Market value equals to what? Dividend over what? Cost of equity. So now, we are going to treat the question under this topic. So let me do it where it's a subscript. So we are going to treat the question under this one. Now, from the part. Okay, please just.
Dividend without.
Yes.
That dividend, okay. That's the current year dividend over. Anyhow, you can just for equity.
No, just for the.
But is that market value?
Yes, market value. What market question now? Okay. So now let me explain something. The thing is that for you to get when you are dealing with that explanation will be under growth. So read the question.
The company is expected to.
No, what's the name of the company? Not give you. Not give us.
But also senior income.
Yeah.
What's it now?
When it comes to this, a company is expected to pay a normal dividend of 48 naira per share.
Wait. I can pass. Page what, please?
350.
351.
So the 350 start 351.
351.
No, on this phone it is 350, on our phone it is 351.
At the Samsung at 100.
Now, you need to itemize first. What are the data we're giving?
They said the company is expected to pay an annual dividend of 48 naira per share.
So annual dividend is what? 48 naira per what? Per shares.
Into the foreseeable future.
Into the foreseeable future.
And the shareholders' cost of capital is 12%.
Cost of capital, that means our cost of capital
It's 12%.
which we denote as what? RP is what? 12%.
The most recent annual dividend has just been paid.
Okay.
Required using dividend valuation model. Suggest what the value of the shares should be. B. Show how this valuation will change if the expected annual dividend in future years is 54 naira. C.
Wait. Let's start with age. We're giving annual dividend 14 naira per share. We're giving cost of equity, which is what? 12%. They now told us that they've paid what?
The most recent annual dividend has just been paid.
Has just been paid. Meaning what? Is SD. There's XD. Meaning X dividend. And there's full due. So XD just means that they've paid the dividend. So I'm not going to collect the next dividend. So I'll just pay the face value alone. That's what I will pay. But when it's full due, that means they've not paid at all. That means the next dividend, I will collect it. So I will pay the market value with what? With the dividend too. Because I want to collect dividend. This one will collect dividend. This one will not. Because they've collected it before you invested in the company. So that's just the two difference. So if they tell you that, okay, they've paid the dividend, then it is what? XD. And also know that if it is full div they are giving you have to convert it to what? XD. So the way to convert XD to full div is that you say XD equals to what? Full div minus dividend. You will get your what? Your XD back. So that means they will give you a dividend, they will give you a full dividend. You have to go back to what? Your XD. So now, they give us annual dividend, they give us cost of capital. So what's now our aim? What does it show?
Yes, using the dividend valuation model, suggest what the value of the shares should be.
Values of what? The shares. Meaning the market value of the what? Of the shares. So now our aim, we know our market value of shares equals to what? DO over what? RE. What is our DO? DO is the dividend they previously just paid, like maybe they paid last year. You understand? That's D naught. Now, I know that before you can say something is D1, that means growth has already happened to it. So now, our D naught, they said the annual dividend is what? 48. So that's 48 naira per shares. And this one is what? 12 cents, which is what? 0.12. So it gives us what? 48 divided by 0.12 is what?
That is 400.
400.
I ain't teach you.
This guy, I pity you every time. No, I was tired of that. Now, somebody took now the lecture. Now, B, what's the next question?
In this sense, show how this valuation will change if the expected annual dividend in future years is 54 naira.
How it will change? What will change? So, can you use this?
Show how this valuation will change if the expected annual dividend in future years is 54 naira.
Okay, just like say, just putting 54 naira. So now, So we can just say change the market valuation equals to what? DO over what? RP, which is what? Now it's no more 48, it already changes what? 54 now. 54 over 0.12. So what do we have? 450. So now what's the 450 naira per? Do you know why this one is in purchase?
No, sir.
This answer is in purchase. It's because your D note is in purchase. If your D note was in total figure, you will get your answer here as well, total figure. Now, you see this cost of equity, you see this dividend yield, they just move it, right? Market value of dividend yield is not the cost of equity. Now, this dividend yield is the one representing cost of equity here. Because market value equals to what? D naught dividend over what? RB is equal to what? Dividend yield. Now, yes, we have market value. Well, you can see we did not make any adjustment because our dividend, our market value was okay. No, not our market value. Our dividend was given in what? In FD. Oh yeah.
Show how this valuation will change if the expected annual dividend in future years is 48, but the cost of equity capital is 12.5%.
It's 12.5%. Now, see. So they are saying we should show how it's going to affect the market valuation if this cost of equity will change from 12% to 12.5. So this one changes from 48 to 54. Now, so now this one is what? 12% to what? 12.5. Is it 12.4? 12.5%. So that means our market value goes to dividend is what? 48 over what? 12.5. Now, we can see something from this without even being asked that the higher the dividend, the higher the what? Market value. From this too, we can see that what? The higher the cost of equity, the lower the what? Market valuation. Do you get it? From this calculation, they are not even saying what to explain. From this calculation, you will notice that when we move from 48 dividend to 54 dividend, you see that using the same what? The same cost of equity, our amount change, our market value change from what? From 400 to what? 450. That means as dividend is increasing, when your cost of equity is constant, your what? The market value will what? Will increase. Another aspect is that if your dividend is constant, meaning it doesn't change, and your cost of equity change, it increases, what will happen to your market value is what? It will decrease. So let's just try to bring out some, let's try something. So let's say $54 over 12, 54 over 12.5, 0.125, 0.125. This means that what? You can see that the dividend is what? Is constant, but the cost of equity what? Has already increased. You cannot get the same value. This one will be more than this one. This one will increase. Now, this dividend yield, how is now, how do they move from year to year? Now, we say dividend yield equals to what? Dividend over market value. I put money in business. Normally, I'm supposed to what? Gain money. The more I put, I'll believe that okay, what? I will get more. Now, some company might say, okay, I will give you 12%. Company that will give you, this company that will give you 12% is riskier than this company that is giving you 12.5. Should I explain? Now, you will notice that this company, when you get the market value, you will see that it ended up at what? 384. But this company, when it is what? At 12%, it gave you what? It's like PE ratio. The riskier the business, the lower the what? PE ratio. If the business is very risky, the PE ratio will be less. Okay, let's say we have similar company. Let's say company A and company B now. This one quoted. This one unquoted. This one meaning quoted means listed in the stock exchange. This one means that it's not listed in the stock. So for me to go and invest in this one, my earnings must be high now. I can say I want to, because this one is listed, and I say okay, if I put my business there, it will be a little bit what? Safe. But this one is very risky. That means if a business is very risky, their PE ratio or their dividend yield will what? It will decrease. If it is more, it will what? It will increase. Notice from the calculation, when it was 0.2, we have what? 450. When it was 12.5, we have what? 384. Now, is there any other question apart from that? Now, on question 2.
You know they forget something. Like say now,
He did, see.
Please, don't play with blessing, please.
No, I'll remember. It's not today.
Sure, you will find like this. Yeah, who forgot what?
You forgot him.
I forgot.
It's just not now.
Now, on question 2, so we are going to be. So let's just start question 2.
A company has just paid an annual dividend of 14
Has just paid.
It's the same thing.
Has just paid the annual dividend of.
There is an group, sorry.
Okay.
A company
has just paid an annual dividend of 14
Okay. Annual dividend.
14 Dividends are expected to grow by 4% each year into the foreseeable future.
Okay. Dividend are expected to grow. That is our growth. We're giving them
4% each year.
4%.
The shareholders' cost of capital is 12%.
How is cost of capital?
12%.
12%.
Why? Calculate the expected value of the share ex dividend using dividend.
Using dividend. Now, I told you for you to do the calculation, you must not ask yourself, is it XD or what? ND. So if it is XD, you turn it back. If it is full D, if it's the XD, you leave it. If it's full D, you will turn it back. Yes, we are dealing with things like that. So now, the formula is market value. You know this one is dividend with growth. So let me just dividend with growth. So now can you read the question for me? Not like what is the requirement, please. I want to
Calculate the expected value of the share ex dividend
using
dividend.
now there's something that we expected. That means we don't vote in it, we are expecting it again. Now, the expected value of the share, that means market value of the what? Of the share. Under dividend using goods, it is the dividend you've not collected you will use to calculate the market value of the share. the dividend will collect this year at the end, let's say 2026, maybe December. We will use to calculate the market value of what the share at the beginning. We've not collected the dividend at all. We will use to calculate what the dividend. That's why to get the initial present value, we will use what the first dividend before we collect. Now let me explain. I cannot use this 48 like that. I must use the what the next dividend I want to collect to calculate what the market value. That is why this one is did not. I just paid it. Okay, let me write it for that. The market value equals to what? D not open bracket what? No, let me pause on the phone. I want to show them how you come about the phone. Remember from this place we are using D not because there was no good. But now, to do the one with good, you can only get the market value, the present market value using what? The dividend we've not collected. And the dividend that is here, we've collected it, right? They say they paid it, right? And it's XD. So that means if I want to get the dividend I will collect this year, if I want to collect the dividend I will collect this year now, that means I will say my what? My D1, because my D naught now is what? Is 48, right? D naught means that the one they paid. Now, I want to get my D1. My D1 now is what? D naught, open bracket what? 1 plus what? G. It's like doing compound interest. You know, we usually have what? Principal, open bracket what? 1 plus rate, principal what? N. And they're doing compound interest. Normally, we are supposed to put N here, but we don't need it because we're already dealing with what? This next thing. So I can just say 1. And 1 is for this is this. So that's why they cannot put it. So now, our D naught is 48. Our G is what? 4%. Now, D1 equals to what? 48 open bracket 1 plus what? 0.04. Which is what? 48 open bracket 1.04. What do we have? 49.92. Now, I told you, because we are dealing with goods, I cannot use this formula like that. I cannot use D1. I have to use D1. I will use D1 for what? The market value that I want to get. I will use what? The dividend I want collected for the market value of now. So if I want to do for next year too, I will do for, let's say, I want to get the market value of what? 2027. I'll have to calculate how much is the dividend I will collect at the end of 2027. So this is the dividend I paid 2026. So I'm not looking at how much is the dividend I will collect at the end of what? 2027. That will come to calculate what the market value at the beginning of 2027. So that's why this formula, our market value will now be what? Now this dividend will be affected. This what? Cost of equity will be affected. Now this dividend now will what? D1 over what? RE minus what? G. And this D1 is still what is here, right? Which is still what? D naught 1 plus G over what? RE minus what? G. I cannot use D naught. It has to be what? D1. D1 means that both has already been what? Applied. That means that's the expected dividend I want to get my what? My market value. My cost of equity will be affected. I have to subtract what? The growth. So that's why this one, if I want to solve it now using all the data I have, it's going to be what? 49.92. This value given, was it approximated? 48 open bracket 1. No, exactly. Over what? Our R is what? 0.112 minus what? 0.04. So there's a little bit difference between this one and this one. This one, good. You must not leave it as D1. That's the D1. This one too. You must not use the whole cost of equity. You have to subtract what? The growth from it. So that's it. So if you know that you don't need to count the formula, you just add it up. I must get my D1. It must be D1, the expected one I must use. And my what? Cost of equity, I must subtract my growth. So now, what do we have? 694 naira. 624 naira per what? Per shares. So is that all the question? Or is there P?
You still need the question.
You don't finish.
Say you're okay, sir. This boy.
Then our assistant said,
We are done now. What else?
So please ask question, last question. Mr. Please, you don't have any question?
like, can you come again with your explanation?
Okay, now. Annual growth, annual dividend is this. Growth is this. Cost of equity is this. They will give you all this data. Now, after they give you all this data, you must make sure that it is in what? In XD, meaning that they pay dividend before they give you all this data. Now, normally, my market value is what? D not over R, that one is easy. But now, because of there's growth in this one, there's growth in this question, I need to get what? The expected dividend. So if I'm not going to use D not again, I'm going to use what? D1. D1 means that dividend that growth has already been applied on. And this is my cost of equity too. I must not use the exact cost of equity. I must subtract what? The growth from it.
I have something to ask. The enterprise value and equity value, is it the same thing?
No. Under income based value.
Can't remember, but it's under the
Yes, they are not the same thing. Equity value is contained in enterprise value. Because that's why we say enterprise value equals to market capitalization, meaning what? Equity value plus what? Preference share plus what? Minority interest plus something minus what? Cash and cash equivalent.
The thing is,
Continue.
the enterprise value is actually the value of the entire business. That is, it is considering both equity and debt. So it's not looking from it. It's not looking from the point of view that
price of ABC company is currently 400 naira.
Let's do PLC.
It's currently 400 naira.
So that means the market value of this is what? 400.
The cost of equity capital is 12%.
So RE, they say cost of equity capital is what? 12%.
The annual dividend has just been paid.
That means it's what? It's XD. That means this market value. That means this market value is having the XD, not the good div inside. You understand? Now, where?
It's expected that the annual dividend next year will be 20 naira per share.
It's expected that what?
It is expected that the annual dividend next year will be 20 naira per share.
Look at this. They say it is expected that the annual dividend per share is going to go 20 naira. That means that it's not D0, it's D1. They say they've just paid. They do not tell us. They now say the one we are going to collect expected article is what? 20 naira. So that means our D1 is what? 20 naira. Because they said this is what is expected. You've not collected it.
I don't get it.
Oh yeah, read that part. Read that part.
It is expected that the annual dividend next year will be 20 naira per share.
20
Has
naira.
not been paid.
Sweet.
No.
Let me read it from
I
the
read it from that place.
The annual dividend has just been paid. It is expected that the annual dividend next year will be 20 naira per share, and that annual dividend will then grow at a constant annual rate into a foreseeable future.
That means now what's that mean? What's the requirement?
Required, calculate the expected annual growth rate.
Now they say you calculate what? G. You see that this G, they say it's going to continue the expected, that means not changing. If it is 4%, they will use 4% to the unforeseeable what? Future. Now, they say they've paid dividend. That means what? XD. That means this market value is what? XD market value. Now, they said they are expected to collect next year what? 20 naira. That means that 20 naira is not D0, it is what? D1, because we are expected to what? Collect. If they say they paid, they just recently paid an amount, let's say 15 naira. That 15 naira is our what? Our D note. D note is what they paid. D1 is what they are expected to what? Pay. So now, you remember the formula?
I'm not done with the requirement.
No, let's do the first.
Is the
Yeah.
They said require calculate the expected annual growth rate in dividend from next year onward.
Okay. Now they say we should get the that's what they say we should get. The annual growth rate that we'll be seeing, we'll be using for the unforeseeable what? Future. Now, remember that our market value equals to what? D1 over what? RA minus what? G. I told you why we are using D1. We cannot use D note because we need to, for us to get the market value on that growth rate, we need to what? Expected what? Dividend. So now, our market value is what? 400. Our D1 is what? 20. What is our RA? 12%. 0.1 minus what? G. So it's not G, it's not G. So what do? We cross multiply. So when I cross multiply, this times this equals this times this. Meaning 400 0.12 minus G equals what? 20 times 1. This times this equals what? 14. That's 48 minus what? 400 G equals what? 20. Right?
Yes, sir.
Collect like 10. Let this one move here, let this one move here. So that's what? 48 minus 20 equals to what? 400 what? G. So when I subtract it, I will get what? I'll get what? 28 equals to what? 400 what? G. So now, so let's say 28 equals to what? 400 what? G. I want to get G. And what is at the front of G? 400. I will divide this side by what? 400. That means my G is what? 28 over what? 400. Because this will cancel this. So 28 divided by 400 times 100 over 1 is what? 7% sharp.
Yes, sir.
So that's our G is what? 7%. So this 7% will be using what? Onward. So
You are doing it, sir.
now on this. Ask question. Produce ask question.
No question, sir. Respect
I
that.
want,
So the
that is the want to do the where
suppose that the stock market now receive new and unexpected information about the company that makes investor reassess the future annual dividend. Investors now expect that the annual dividend next year will be 10% lower than the previous expected. And
wait. They said that the expected annual dividend now is no more 20 because an information came out that made them what? They assess what? This annual dividend that is 20. So the investor is now projecting that okay, our annual dividend will go 10% lower than the one that what we are expecting. 10% lower means that what we are going to be only getting what? 90% of what is 20. So now the first thing is that based on the new information, the new annual dividend will be 10% less, meaning 100 minus 10 over 100 times what? 20, which is what? 90 over 100 times what? 20, which is what? 18 naira. So now, because of the information now, it's not going to what? 18 naira, not 20 naira again. Do you get? They say based on the information that we just got, The investor wants to reassess this annual dividend of 20 that they are expecting. So they are now projecting that okay, it is going to be what? 10% less. So if it is 10% less, it cannot be this 20 again. Instead of collecting 100%, we will be collecting what? 90. That's why I said 100 minus 10 is what? 90. So 90 over 100 times what? 20 will be what? 18 naira. So now continue.
So, and that annual growth in dividend in subsequent year will be only 4%.
Now, they have adjusted the annual growth to what? 4%.
Calculate the price that should now be expected for shares ABC.
Now, they are not telling us to get what? This market value now. Now, based on all this data they are giving us, they say we are supposed to get market value of 400. But there's any adjustment on the what? The growth and the what? The annual dividend. That means the market value will what? Be affected. This is the formula. They are telling you this one will change. This one will change. That means when I input everything, I can never get my phone down. Is either I get higher or I get what? Lower. So that let's do it. So the market value equals to what? You know is what? D1 by what? R minus what? G. Your D1 is the expected what? Dividend. Your R is the cost of equity. And your G is what? The growth applied. So now our D1 now is what? 18. Is what? 18. Our cost of equity, they don't tell us anything about it, so we'll use this one back. 12%. So that's what? 12, so that's 0.12. Minus, they told us that our growth is going to change from 7% to what? You know we got 7% here. Yes. It's going to change from 7% to what? 4%. So 0.04. So what do we have?
Two to five.
225. You see that the market value is lower now. 225 what? Naira per what? Any question?
When I want to
You want yourself.
Dividend. Did they give us the market value?
We are not ready.
Oh yes.
Annual dividend of what?
63 naira.
Build 20.
They just paid. If they just paid, now did not.
This dividend.
Hey now! I see that one. I don't say it's that one.
I just dey ask.
Oh yeah.
Continue. Wow.
This
No,
dividend
people
is
say.
expected years. 2 more years, sorry.
2 more years.
But from year 3, it is expected to grow by 3% each year into the foreseeable future. Sorry.
Wait, year 3. What's the growth? It will go by what? Annual dividend.
3%.
We go by what? 3%. Oh yeah. Oh
The
yeah.
cost of shareholders' fund is 10%.
So that means cost of equity is what? How is what?
10%.
10%.
Require what should be the current market value of the company shares?
What should be the current?
Market value.
That's how the question has been.
Yes.
In this one, they are giving us for, that means last year they paid 63. They are saying for the next 2 more years they are going to pay what? 63. That means it's like saying your D0 is what? 63. Year 1 is still what? 63, no growth, right? Year 2 is still what? 63, no growth, right? Now when you now go to year 3, growth came in. Get it? They were paying 63 before, it was constant without growth. Then I said, last year they just paid the dividend, 63. Then I said 2 more years, that means my D1, there's no growth, right? It's 63. My year 1, there's no growth, 63. My year 2, there's no growth, 63. But my year 3, there's a growth of what? 3%. So now, they are not saying what is the current market. That means what? Current means what? The present value of that market. So we are going to be coming from what? Year 3.
That, so are we going to use that formula of that
First calculate,
discount
you calculate
factor or
We are going to use yes. Now, so now let's draw a grid. Let me forward give me this formula. Future value equals to what? Present value open bracket what? 1 plus what? R is power what? N. This R that is here is cost of equity. This R. This N is not everything.
That's very visible. Find the glass.
Future value.
I don't know because it's
Steven. Present value. Now that's the teaching. Your R for this question is what? Cost of what? Everything. And your N is what? Number of what? Of years. Now, I want to get future value. But my present value is something, so I can get it. So what if, okay, let's say in year 1, I have 15 naira. I invested, no, I'm using an example now. I'm giving an analogy now. Let's say, I want to explain how this future value is. Now, let's say you invested 15 naira in the bank. You want to know how much will my money yield in the next 5 years. Right? In the next 5 years. That means from year 1 to what? Year 5. That means your present value is what? 15 naira. Your number of years is what? 5 years. And you have your discounting what? Rate. But in this question, our discounting rate is what? Our cost of what? Equity. But now it is not possible that you should go from the future. You are in year 5, then now go back to what? Year 1. That's what we call discounting. You know there's something we call premium. There's something we call what? Discount. There's something we call face value, upper value. So when you are going back, you are going down. It's what we call what? Discount. So now, here they are telling us to get our what? Our present value. So let's use this formula. Right? So we can see that let's divide, want to get present value, divide both sides by this thing like this. We want to remove this one, we will divide both sides by what? This. Meaning that we know our future value equals what? Present value by 1 plus what? R raised to power what? N. Let me divide both sides by what? 1 plus R raised to power N. 1 plus R raised to power what? N. Right? So this we cancel what? This. Then I can say my future value equals to what? My present value equals to what? Future value over what? 1 plus R raised to power N. So there's something I can do here under laws of indices. I can bring this one up. It will become what? Future value go by 1 plus R raised to power minus N. So that's how they got this formula. That's how they got it. Now, this is what we need. We don't need this one now. But we are still going to what? We are still going to use it. Now, let's just begin. So, yes. Dividend. Discount. Discounting rate. Discounting factor is what? 10%, I mean. Right?
Yes, sir.
Then our present value will be what? We'll get the present value. Now, for our year 1, what is our dividend for year 1 from this question? 63, I think. What is our dividend for year 2? 63.
God. Dividend for your kid.
Dividend for year 3 is what? 63, I think. Yeah. Dividend for year 3 cannot be 63 because they told us that year 3.
When they said for 2 more years.
And 2 more years already contain year 1 and year 2. Do you understand?
Okay, sir.
2 more years already contain what? Year 1 and year 2. That means dividend for year 3.
It's supposed to be the 3rd year now because the first one is like.
It's there already. So they now
So,
said for 2 more years. 2 should be plus the year more control.
So it should be 3, like 3. Do you understand?
So this thing should now start from the 4th year.
When do you pay dividend? Most companies.
At the end of the year.
At the end of the year. At the end of year 1, base 3. At the end of year 2, base 3. At the end of year 3, how much will you pay? Is the you have to apply both. There's D note. Do you know D note? They said in the question that they just paid an annual dividend. That one is what? D note. So they now told us that they paid for extra 2 more years. That means from that D note to D1 to what? To D2. Do you get it?
The only thing is not just 0 years there. But it's not needed.
It's not needed. Yeah, it's not needed. So now, I want to get for what? The 3. So what's going to be my what? My D3. For me to get D3, that means I must know my what? D2.
Yeah.
You know when I was doing D1, I was doing my what? D0. So for D3, I was doing my what? D2 open by what? 1 plus what? G. What is D2 here?
Wait.
Yes, what?
I don't understand. D3 minus D2. Why would you do that?
That time, when I wanted to get D1. What did I say? D1 is equal to what? D0 open by what? 1 plus. Before I can say something will go next year, I must know the previous one. Before I can get D, I must get what? I must know what D. So that's how it goes my D2. So it's not by determining the formula. You have to understand what is going on. So year 2. For year 3, the dividend I will collect at the end of year 3. I must know the dividend I collect at the end of what? Year 2. Meaning that what? 63 open by what? 1 plus what? 0.0. So what's my answer? Hmm. 64.8. 64.89.
The shy,
These are those. Now, what we are after, you know, for them to say dividend that we collected at year 3 has 3% in it, right? That means our market value is for what year? It's for the beginning of year 3 now. Yeah. Remember, I told you, his expected dividend, I used to get the market value at the beginning of it. Now, 2024, 2025, 2026. Now, I'm going to, this is the beginning at 1. This is the end at what? 31st what? 12. The value, the dividend I get here, let's say D3, is what will give me the market value of this year. I will not discount it out.
No, I was asking.
So now, my discount for year 3 will get me my what? My market value in year what? At the beginning of what? 2026, right?
Sorry. I don't understand what's from this place that you did 2024.
Okay. D1, dividend 1 will get us our market capitalization at the beginning of 2024. It is expected dividend that will give you the market value at the beginning. So I must know the what? The dividend at the end of that year to get the market value at the beginning. That's what we are saying. So for D2 now, I must know the market value at the end of this year to get what? I must know the dividend at the end of this year to get my market value at the end of what? At the beginning of what? This year. Your expected dividend, you get your market valuation at what? At the beginning. You know that the beginning of 2026 is the end of 2025 now. Now, what do you not understand? Let me explain.
No.
Do you understand what I just said?
Yeah.
No problem.
I don't understand.
Okay, now, I told you that the dividend you used, you want to get market value at the beginning of 2026, and you know that the market value at the beginning of 2026 is the market value at the end of 2025. So now, but let's just say it's at the beginning. Now, dividend 3 will give us market value at the beginning, right? Dividend 2 is at the end, but let's say will give us market value at the beginning. Dividend 1 is at the end of the day that will give us market value what? At the beginning. So that is why when we are doing this question, we got what? D3. We said it's what? 64.89. That means what will it give us? It will give us what? The market value at the beginning of what? And it's still what? It's not D2. It's the market value at the end of what? 2025. It's like closing become what? Opening. Something like that. So that's how we're going to target. So now, we've gotten our dividend. This dividend for year 3, we just need to get what? The market value as at what? As at year 2. Do you get what I'm saying? What I'm still saying is that this D3 we are getting, it is still for what? The market value at the end of what? 2025, right? Now, you know this is year 1, this is what? Year 2. Now, after doing this, let us get the market value. Let's get this market value. So if you want to get this market value, the market value is going to what? You know, dividend is what? For year 3, that means if you are getting the market value is either market value at the beginning of what? D3 or at the end of what? D2. So now, I'm explaining why, because I want you to reason like closing, opening. But most of the time when you are using numbers of years, it's the what? It's the closing when you use. Now, I will explain what I'm saying now. Market value is going to be what? 64. Why are we putting 64? Because we apply what? Growth. The reason why I was putting D1 at that time over what? RE minus G. Because this D1 already apply growth. I cannot put D0. It's not 63 I will put there. So now, over RE minus G. What is my RE? My RE is what?
10%.
10%, which is 0.1. Minus, what is my growth?
0.03.
My growth is 0.03. So what do we have? Ask question. It was to be like
914.286 approximately.
What should I put in?
914.29.
914.2857143.
Let's just leave it like this. Now,
Sorry.
okay.
That's 0.1 from you.
10%.
10%. Yeah. Okay, you know what? Let me write this.
RE minus G.
Thanks
That
for
they were school is mathematical.
Market value of what? Of 31st 12 year 2 is what? D3 over what? RE minus what? G, which is what? 64.89 over what? 0.1 minus what? 0.03. And you get to what? 914.
calm down.
To school.
You talk too much.
You are recording this.
0.29. 9 to 7.
Eh?
That's why I get this point I carry now. 9 to 7.
9 to 7, abi?
Yes.
So please let me read.
Why not? This is 4.89.
And now,
See, take now.
let me see what you did.
9 to 7.
9 to 7, he's not giving me
How do we
points.
get different?
That's what we use. No use point 89.
Oh, yeah. I thought
9
9 to 7.
to 7. So now, it is 9 to 7 will come and put here. But remember that this 9 to okay, you will notice that I did not write here 3. Why did I not write here 3? Because we don't know, we can't know the market value of what? Year 3 if we don't have the dividend for what? For year 4. You understand? So the only place we can stop is what? Year 2. The reason we are stopping at year 2 is because we know the dividend for what? Year 3. For you to know if you know the dividend beginning of year 3, that means you can get the market value at the beginning of what? That year 3, and still the market value at the end of what? Year 2. Right? Now, so after doing this, we can then move towards, now, we want to discount. We want to discount this thing. This first year, I told you this formula is what we use to discount. We are moving from what? Future value to what? To present value. Now, we want to get the first present value. Or let's just go to discounting factor. See, this is what we are going to be using. This. What we are going to be using. This future value is this is 3 years. So let me just get what is here first. So now, the first one for year 1 is what? 1 plus 0.1 is power minus 1. How did I get 0.1? They said our cost of equity is what? They're the same. So this one, when you do this calculation, what do you have? This is power minus 1. No, it's not possible.
0.90.
You do not put this power minus 1, you put 1.
0.90.
9090. Now, for year 2 is what? 1 plus 0.1. This power minus 2. What do you have?
0.8264.
0.8264. Now, this one too, you will use the same thing. Why? Because we are discounting from year 2. This dividend is for year 2. This dividend, and this dividend is for year 2. This market value is for what? Year 2.
Yes.
You know this, both of them. We're still going at the end. 63. Year 2 dividend. 927 is market value of what? At the end of what? Year 2. Which you can still relate to what? Beginning of what? Year 3. So now we are going to discount this, discount it. But this one is still what? Year 2. So we are still going to do the same thing here. 0.826. So multiply this. The total is going to give us our current market value.
57.267.
57.267. Or let's say 0.27. We have
52.16.
52.06. That one.
97.
Yes, 97.
766.
766.07. Oh, you add them to the other. 875.40. So that's the market value. So total market, current market value equals to 875.40. So that's it. Okay, now we're going to treat this next question. I think this is the fifth question or the fourth question. So now your target what?
Target paid a dividend of 250,000 this year.
Let's say DLC or limit. Let's say DLC. He paid what?
Paid a dividend.
Target paid what?
Target paid a dividend of 250,000 this year.
This year?
Yes.
Okay. Wait. Dividend this year is what?
250,000.
Mm-hmm.
The current return of shareholders of companies in the same industry as target is 4%.
4%. That is cost of equity, I mean.
The current return to shareholders of companies in the same industry as target is 12%.
Wait, come back again. Is it 12% or 4%?
12%.
12%. Oh yeah.
Although it is expected that an additional risk premium of 2%.
Okay.
Stable to target.
Wait, additional risk
Premium
of 2%.
of 2%
Where
will be applicable to targets
okay.
being a smaller and unquoted company.
Okay, this is an unquoted counsel. 730. Jesus. Oh yeah.
Require compute the expected valuation of target if the current level of
Wait, I said you can compute what?
the expected value of target
Okay, now the first thing, market value of what?
of target if the current level of dividend is expected to continue into the foreseeable future.
The expected.
The current level of dividend
Okay.
is expected to continue.
Now, they said that means they are saying at least 250 will continue to pay the exact 250 into the foreseeable future. That means there is no good, right? I'm not informing that if there is no good, meaning what? G over what? R in. Meaning that dividend that they just paid. Now, our deal is what? 250. What is our RE? Our RE is cost of equity. This cost of equity and this additional premium, we need to add them together. Do you understand? So that's going to be what? 14%, right?
Yes.
So let's just come here and say total RE equals to what? 12% plus what? 2%, which is what? 14%. So that's what? 0.14. So what do we have for our answer?
178 5714
178.
5714.286.
Okay. So that's that for that. For B, now what do you say?
For B, the dividend is expected to grow at a rate of 4% per annum.
Now they say this one,
Future.
this B, the dividend is expected to go at a rate of what? 4% per annum. Meaning we cannot use this. This our D1 is what? 250. We cannot use this one. It's D1 we use to get our what? Market value. Now let's say given a growth of 4%, they say this is the data they give us. They now said we will be growing by what? 4% into the unforeseeable future. So we are not going to use D1 this 50. We are going to use what? D1. Meaning our market value equals to what? D1. Meaning the expected, that means the expected dividend we are going to get next year. There's going to be what? Growth with it. We cannot get market value under growth without converting it from D0 to what? To D1. Right? So what is our D1? You know that so we have to get our D1 first. Our D1 equals to what? D0 open bracket was 1 plus what? G. Our D0 is what? 250,000 plus what? 1 plus what? Our percent is what? 4%. 0.04. So when we do this, what do we have? Sharp. 260,000. Now, number C. What did they ask us? What's the C?
The C says that the dividend is expected to grow at 3% rate for 3 years and 2% afterwards.
Now, for the next 3 years. So we've gotten our D1. So now if we need to get our market value. And we know that market value equals what? D1 based on this question, it can change. It might not be D1, right? D1 over what? RE minus what? G. What's our D1 here? 260 over what? What's our RE? 14%.
2%, yes.
That's 0.14 minus what? 4%.
0.4. 0.04.
So 0.04. So when you do this, you get what? 2.6
million.
But wait, I want to ask you, are you sure this is correct?
Which one?
250,000 divided by 0.04, it should give you a million.
It should give us what?
It should give you millions.
You know, see what you like.
Give me the figure again.
250,000.
250,000 divided by 0.04.
178 5714. That's 6 figures.
178
5714.
5714. Yes, now
1,286.
1,286. This is what can be 2 million.
It's 7 million.
So that's our C now. We have got our C.
The dividend is expected to grow at 3% rate for 3 years.
Okay, dividend rate 3% rate
For 3 years.
for 3 years.
And 2% afterwards.
And 2% afterwards. Right?
Yes.
Now there are 2 ways you can do this. That means this thing will be growing. It will be going for the next 3 years. As rate of God. You can use annuity here. You can use annuity here. So now, but I want to break it down. Do you understand? I want to break it down using what? If you use annuity, it's very fast. But let's just break it down using what? The jingle. So now, we have what? Yes, I mean, we have what? Let's say dividends stroke market value, anyone that is there. And we have what? We have discounting factor. Our discounting factor is what? 0.1
Yes.
we say 14%. And we'll get our present value. Oh yeah, no. Let's do this kind of file. Let's do it. So now, year 1 is going to go by 3%. Year 2 go by 3%. Year 3 go by what? 3%. Meaning I told you the formula I gave you that present value equals to this and this and this. So this one will be after the future value. Future value equals what? Present value go by 1 plus our risk power. Our present value now is what? We just paid what? 250,000, right? So for year 1, our future value is what? 250,000. Open by what? 1 plus what? Our rate is what? 0.14.
Yes.
Risk per what? 1. Risk per 1. So what are we going to have?
I promise you. $285,000.
Eh?
285,000.
25,000 sharp, I mean.
Yes, sir.
So for year 2, it's going to be what? 250,000. Open by 1 plus what? 0.14. This per what? 2. It's going at the rate of 3% for the next 3 years. So we become calculating the future value.
324,900.
324,900.
900.
So for let's say for year 3, I mean, okay, let me just write it. 215,000 plus 1 plus 0.14. This power of you said it was
37386.
now these are our what? The dividend we are going to dividend, yes. The future dividend we are going to be getting for year 1, for year 2, and for what? For year 3. But you now notice that afterwards, they said that what? They said that this thing what? It changed from 3% to what? To 2%. So that means, what are we going to apply the 2% on? Is it 250 or this value? As you move, like we move from 285 to 324 to what? 370. We'll move to what? Normally, if you want to do a 4, what are you supposed to use? We are supposed to do what? 250 over by what? 1 plus 0.1 is per what? This one was 4 abi? But now they said it has what? It has changed. From 2, it has changed from what?
8%.
Oh, please, there's an error which is not going to my notice. It's not cost of equity you use here. It's good.
Yes.
It's good because it will change. It's 0.0 what? What's the first one? 3. And this one is 0.0 what? 3. And this one is 0.0 what? It is when you are discounting, you use what? You use this for 2%. So now let's just erase this one back.
257,500.
This one is what? 257,500.
500.
And this one is what?
265,225.
265.
225.
And this one is what?
273,181.75.
273,181.
0.75.
I just say 0.12, right? So now, so let me just put all these values. Let me put 257, 500, 265, 225, and we have 273, 182. Now, we are changing from 3% to what? To 2%. That means if this value that we get, we will apply 2% on, yes, or 2. So that means for my year 4 now, it's going to be what? 273,182 open by what? 1 plus 0.02 is per what? 1. Why is this per 1? Because with this the first year we are changing the what? The percentage. So what do we have here?
278,645.64.
278,645.64. And just do 0.46. So, but now, remember that this year 4 is the dividend we are going to collect in year 5. And it's going to give us our market value as what? That year 4. And that market value at the beginning of year 4 is still what? The market value at the end of year 3. Let me explain it. This year 4 dividend will give us the market value at the beginning of year 4. Which is also the what? Market value of, at the end of what? Year 3. So that means when we are discounting, our end is not going to be 4, our end is going to be what? 3. So now, so for year 4 now, or will just be a 3, the market value is what we will not get. Let's get the market value of this dividend. So now the market value of 34th, let's say 34th 12, let's do that one. Let's say 34th they are collecting their what? Let's say 34th 12, year 3 is going to be what? D what? D4. D4. Yes. Remember I said dividend 4 will get what? Market value of what? 40, and you see the what? Market value at the end of what? Year 3. So D4 over what? RE minus what? G. Now, our D4 is what? 278,646 over our cost of equity is what? 0.14 minus. Now, is it going to be if what? Is it going to be this one we are going to use? This 3% or is this 2% we are going to use? Why is it 3%? And you know I told you, because it's for year 3, you see the market value at what? Year 2. And you see the market value at what? Year year 4. Remember when we were doing that time when we were doing some examples? It is that dividend for that year. We are going to have a growth of 4%. Year 4. Okay, let me just use this example. Year 4 is having a dividend of what? This. And a growth of what? 2%. It's still that 2% we still use to get what? Market value at the beginning of what? Year 4. But we know at the back of our mind that the market value at the end of what? Year 3. So it's not going to be 3%. It's going to be what? 2%. Because this dividend was brought in at what? Year 4. So now it's going to be what? 0.02. So let's do this one here. Like this. That's 2 million.
2,322,050.
2,322,050. So that's the market value. So that's what I was thinking. 2,322,050. Now, for us to get the discounting factor, we know that I think that discounting factor, this is the formula we use. 1 plus our risk power minus n, right? So now, the first one for year 1, let's just do year 1, 2, 3. So discounting. Now, this R is the cost possibility we are going to use, which is what? 14%. Meaning for year 1 is going to be 1 plus 0.14 raised power minus 1. Year 2 was 1 plus 0.14 raised power minus 2. And year 3 was 1 plus 0.14 raised power minus 3. This one is what? 769.5. And this one is what? 0.674. 675 sharp. 50. So let's put it here. You can see that you don't look for year 4. Why did I not look for year 4? Because this market value is still the end of what? Year 3. So when we are using the discounting factor, it's the discounting factor of what? Year 3 we are going to use. But when it comes to this one, the percentage is the when it comes to the growth, it's the growth of that year 4 we are going to what? Use. So now, I'm just going to put this in 0.8. Please, if there's question, ask. 0.7695 and what? 0.6750. This one to 0.6750. So what do we have? This one 225,884. Point 15. Down. $2 million. No, it's not this one.
2040 and 90.
The third one. 184,397. 397. 0.85.
This one. There's not this one for 8.
$204,090.
Wait, which one? This 3 are you?
The first one, second one.
404,090.
090 point.
Yeah.
And
Point what?
0.63.
60. Let's just put point 1 this one here. Approximately. Now what about this one?
1,567,000.
567,000.
383.75. Sorry, sir.
So add it together. What's that?
scam. I'm just trying.
But that look at what you're putting in the calculator. How would you do?
Keep credit card.
How will you get it? These are those.
Good requirements.
You don't see the one that I'm going to do.
Yeah, you need to do that.
Yeah.
I want to confirm with you.
Hi.
Make mistake not to me.
Up and DGPs.
I don't want common figure for you.
No, sir. Others want to fly. We say they want to fly.
We have 2 million.
This one.
Yes, now. 191,757.
Alright.
It's sure.